Hello, everyone. Thanks for joining. I think we're ready to get started. Welcome to this Greenwich Associates webinar. We're excited to have everybody here, excited for our panelists. We're going to focus on the U.S. Treasury market today, changes in market structure. Always an interesting market, a very important market to the global economy, of course, but particularly interesting this year in light of the market crisis brought on by the pandemic and what changes that has brought and might bring going forward. All of which we will talk about today. I'm Kevin McPartland. I'm the head of market structure and technology research at Greenwich Associates and will act as the moderator today. Before we get started with today's discussion, just a couple of housekeeping items. If you hear an echo, so please check your audio setting to make sure if you're dialed in to make sure that it says telephone if you're not using computer audio. Questions are definitely welcome. You'll see there's the question box through the GoToWebinar software there, so please enter those. We'll try to answer as many as we can. You can enter them throughout. We'll try to pick them up as we go. If not, we'll get to some at the end. If you have any additional questions after the webinar, we'll provide contact information, so please feel free to send those after. And finally, the webinar is being recorded, and the link to the recording will be sent to all of those who are registered for the event in the next couple of days. And so with that, let's get into it. Really excited for the panelists we have today. We have Mike O'Brien from Eaton Vance, Jamie Mortimer from JP Morgan, Nicola Hunter from Market Access, and Troy Kane from Citadel Securities. Thanks all of you guys for joining. So let's jump on in, right? So before we get into some of the market structure items, let's talk about sort of where the market has come, right? Have we stabilized since sort of the crisis really started in March, April? Do we feel like we're back to business as usual? And then, of course, we have the U.S. election coming and the volatility that might come with that. So I don't know, maybe, Jamie, you can start us off. Sort of how does the market feel now? Are we back to some semblance of normalcy?
Yeah, sure. Thanks, Kevin. So yeah, maybe it's worth putting it in context in terms of what we saw during March and April to start with. Yeah, there was obviously some pretty big impacts in terms of the bid-offer spread that we were seeing across the curve. Not so much at the shorter end, although there was a pretty significant drop in liquidity. But in 30s in particular, we saw bid-offer spread widen out 5 to 10-fold. And we also saw liquidity drop very sharply in the off-the-run series. So, for example, in the triple olds, we saw triple old 30s, we saw bid offer increase 10x, which is something I've never seen before. Despite this, we saw increased volumes, increased e-volumes across the platform. So we actually saw, from JP Morgan's perspective, 150% increase in the flows on some of our D2C platforms. I think that was partly driven by other dealers disabling auto quoting. So maybe there were less people participating in the kind of electronic market. But yeah, there seems to have been this kind of transition that's been a little bit sticky in terms of clients moving onto some of the e-platforms. And we continue to see increased volume on our e-platforms relative to voice. So that's something interesting and seems to be kind of here to stay, and maybe that's affected by people working from home, etc.
Yeah.
In terms of where we are now, it's definitely stabilized a lot. We've seen the bid offer come back in to kind of where it was, maybe even tighter than it was in February. It's a lot more competitive, I think, as other dealers are trying to pick up market share. So yeah, I mean, I think it is kind of back to business as usual, pretty much. Obviously, we have the US election coming up, which is going to be interesting. But yeah, from our perspective on the dealer side, it's kind of business as usual at this point.
That's great, Jamie. Thanks. And we're going to get back to that comment about the clients looking on e-trading, looking to e-trading a bit more. Mike, so speaking of investors, from a buy side perspective, so what's the last 6 months been like for you, and where are we now?
Well, obviously, I mean, we had a lot of volatility and the challenges that Jamie just mentioned in March and April. But to me, the biggest difference is, are we back to normal? Well, I'm still sitting in my house, so no, we're not back to normal. There's all sorts of challenges associated with that, and I think as an industry, we've done a good job of making the transition smooth, but we haven't been successful until I think we really go back to normal, and those who will be going back to the office are back in the office. And so I think things are settled down now, but from an asset manager's standpoint, I'm still concerned if we go through that bout of volatility again, and I think you hinted, the election could potentially be a scenario that creates that type of volatility. What do I need to be ready for? Am I set up to get done what I need to get done? And what should I expect? And so, yes, maybe from an asset manager standpoint, we've passed the test so far, but that doesn't mean that we're out of the woods yet.
Yeah. And do you feel like that you said about preparing, right? If there's another bout of volatility, does that feel more like a people preparation problem or a technology preparation problem? I guess the answer is probably somewhere in the middle.
Yeah, I mean, I think it's a little bit of everything. I think one of the things that has happened is in March, we were essentially everyone was in the same boat. We had just all moved to work from home. The timings may be a little bit different, but largely we're in the same camp. And now I think we're going to see a little differentiation as we've moved from March into now October. Who has prepared better? Who has prepared worse? What type of unforeseen events are going to differentiate people? There was no differentiation, from on the buy side perspective in March. Again, we're in the same boat. Now, another bout of volatility, I guess, could potentially test who's better prepared this time around.
Fair point. Troy, from your perspective, right, a non-bank market maker, Citadel Securities, sort of like, how did that work through the volatile periods, and where are we today?
Yeah, I mean, to echo, I think what everyone is saying, we were very impressed with how the industry was resilient and able to facilitate the trading in a, working remote environment. And while things have returned to a little bit of stability, we're taking the lessons learned from March and April to make sure that we're ready for any increase in volatility or potentially, having to go back into lockdown or any kind of work remote situation over the next 3 to 6 months. And we saw a lot more utilization of our electronic market making capabilities. Even though there was an increase in voice trading as well, we saw a good increase of our electronic execution. And I think it just shows the value of electronic trading in a period like March and April, and why we need to improve access to electronic trading for all users, all participants.
Yeah, it did seem like a good, solid test of the market structure in general and the e-trading growth that we've seen over the last several years. Nicholas, so you're right in the middle of all that, right? So what was your experience, with the platform and working with your clients more broadly?
I think March, of course, was the first real test for streaming liquidity. Up until this crisis, we've not seen any real stress of the market. So I think what it demonstrated to us is that the streaming protocol is, of course, fit for purpose. But I think just to get back to your initial question, Kevin, about are we back to normal? I mean, I don't think we're back to normal by any stretch, because to echo Mike's point, we are still working from home, and I think in this remote environment, it stifles innovation a little bit because people are still focused on not the norm. And also on top of that, the Treasury market is absolutely muted. It fell off a cliff into April, and in terms of overall volumes, we're seeing something which I think we'd say is not normal for typical volumes at around this time of year, and very much below average. But I think that's largely due to the timing, and many are keeping their powder dry ahead of potential volatility expectations as we lead up into the election. So again, interesting time for us as we move forward into the election to demonstrate that the electronic trading and new protocols within electronic trading will be fit for purpose as different market conditions ensue.
Yeah, for sure. And it's interesting, right? It's interesting that volatility, if you compare right now to October of last year, right, that volatility is actually quite a bit lower than it was last year, which could be in large part to the Fed saying rates are going to stay where they are for the foreseeable future. But let's get into the protocol discussion a little bit, Nicola, that we started talking about streaming. I mean, we noticed a few interesting trends that we're interested to understand if it will be, is it a structural change? Is it a cyclical change? We've noticed that order book volumes as a percentage of the total seem to be down. RFQ volumes as a percentage of the total seem to be up. Streams are holding on and growing slowly. So what's been your experience and any crystal ball? And then we'd love to hear from the market participants where they're seeing things.
Sure. So, I mean, I think to your question, is it growing? I think the answer to that, streaming that is, I think the answer to that is yes, but much more slowly than we would like. And I think that's in large part down to the market conditions. And remote working isn't really that conducive for innovation and trying new things. It's just not normal. Desktop real estate is at a premium in your home offices. So launching new venues, new screens, and doing work coding to new APIs and new protocols has absolutely been hindered over the last 6 months, as people have just been trying to get their breath back somewhat. But in terms of the future for streaming, I mean, obviously, I'm very bullish about that, as presiding over the former liquidity edge platform now called Market Access Rates. It's early days, but we're about to launch streaming via our Market Access front end, and we've spent quite a bit of the last 6 months, albeit with the constraints of remote working, engaging with our customers on the dealer to customer side, looking at the different use cases for specific firms and desks and how streaming will benefit those customers, how we integrate it into their existing workflow, which of course is a key component for success in any launch of any new protocol. And we're fairly confident that we're going to be seeing success and further growth in the use of streaming protocols in the coming months and years. There are just too many benefits to streaming that I think can't be ignored by the buy side, as it's been embraced in the dealer to dealer community.
Sure. Yeah, that's right. And you've had the joy of doing a firm integration in the midst of all of this as well.
Yeah, I mean, it's undoubtedly been challenging trying to integrate an acquired company into a mature fixed income business that is market access. But it's testament to, again, resiliency and the ability to adapt, and that we're on track for our streaming launch via the market access terminal towards the end of this year. So that should be interesting. It will drive a shift, is what I'm anticipating in how volume is transacted.
That's great. And so, Jamie, you mentioned about more use of Echannels, right? So does your experience reflect what Nicola is seeing?
Yeah, I think we've definitely seen an increase on the RFQ side. We have seen a bit of a flattening out on the streaming side. And I think from our perspective, that seems to be because there's still a bit of stickiness around the use of RFQ. I think one of the reasons is that clients having to use one system for on the runs and perhaps the first 3 holds, and another system for everything else like builds, tips, etc., the rest of the securities universe, doesn't necessarily work from a client perspective so well. So I think there probably needs to be some more integration of streams into the more traditional workflows, or a much broader range of products into streaming. So builds, tips, etc., and getting those into that ecosystem. That's something that we're working on. But I think we'll get there, and I think as those things come online, we'll see continued growth on the streaming side. I think the other thing is that many clients need to show best X. They need to put multiple dealers in comp, and that's probably best served through a third-party aggregator as well. So I'd expect to see that continue. Those platforms continue to grow.
Sure. And Troy, from your perspective, is that a supply, like which comes first, right? Is it that there needs to be more supply of streaming and more instruments, or do the customers need to then demand it more so there can be more streaming?
Yeah, I think from our perspective, I think there needs to be a lot more demand. I think there's good amount of liquidity provision out there in streams, but I think, you know, as a liquidity provider, we want to see that increased demand coming in, and I think that's going to come with more integration, more product sets. I think that's a great point. As you get into those end users liquidity pools, whether it's stream or RFQ, then they're going to naturally, I think, gravitate to stream over time. It's just getting them there for, you know, initially. But you know, from our perspective, we like to see demand, and that's kind of how we kind of go in direction, and we listen to our clients and we try to provide them the liquidity and the mechanism that they want it in, and we're willing to make it in all executing protocols. So
that's great. And Mike, yeah, I mean, Eaton Vance and you specifically, you've always been sort of on the forefront of new protocols. I mean, what's been your experience so far? Is this something you're pursuing?
Well, certainly, I mean, I'm always interested in new protocols. You know, one of the things from my perspective, and probably the middle kind of maybe 80% of the buy side, so leave out the tails that either have fantastic technology or suffer a little on the technology side. The difference between RFQ and stream is not that significant to me. You know, an RFQ and a stream to me are largely the same thing. One is on demand and one is on request. I could see from a dealer or liquidity provider perspective why those are very different products, but from a buy side perspective, I'm not so sure they're that different. And part of the reason for that is the mainstream technology for asset managers, whether it's an execution management system or an order management system, the technology isn't there yet. I could see the use cases down the line of why those two protocols will be very different. But yeah, I think, again, for that middle group of asset managers, you know, the difference between the two, we just don't have the technology to make that big of a deal of the difference. It's coming. I think it's coming rapidly, but I don't think it's there yet. In terms of other protocols, look, I've always been a big supporter of central limit order books, whether it's you know, in the conversations about CEFs many years ago or in the Treasury market. But I'm not just focused on central limit order books. I'm interested in lots of different protocols. I think someone here mentioned, you know, the protocols from the dealer-to-dealer market gravitating towards, you know, they call it the dealer-to-client market. That largely hasn't happened yet across asset classes, including treasuries. And I would think treasuries would be among the first places for that to happen, given it's the most liquid fixed income asset class. And so, you know, I'm always interested in, look, my philosophy for my traders is I want to give them as many tools as possible, whether it's streams, RFQs, order books, or anything else that's available, and then let them make a decision on a trade-by-trade basis. What is the most relevant protocol to use? This isn't one versus another. This is about having a variety of tools and making the best decision on a trade-by-trade basis.
That's great.
Sorry, I just wanted to jump in and say I absolutely agree with Mike here. When it comes to streams, it's an evolution, not a revolution, and also it's not an either or an or. It can be a blended experience, and I think the biggest barrier to speed of integrating streams is workflow and integration. Absolutely, hands down. But I think if we get that right, if the various venues out there get that right and work with the OMSs, then the benefits of streams can be realized in conjunction with RFQ, which is actually the very definition of best X. The price transparency that you get through streams is unrivaled, in my opinion, and the ability to leverage algo execution and improved automation and increased efficiencies through streaming that you can't necessarily realize as effectively through RFQ will warrant the investments that will need to be made in growing the protocols.
Yeah, I mean, there's a lot to unpack in there, right? So I picked up a couple of things, right? So on one of the things Mike said, right, streams effectively are continuous RFQs, and then one could argue that order books are just aggregated streams, right? So they're different, but they're certainly related. And the market does seem to show that there's so many different types of market participants that there is need or interest in all of them. So I'd be curious to hear from Troy and Jamie. So the other thing that Mike said was about D2D and D2C markets not overlapping that much yet. Do you agree? Do you feel like that's changing? And then on the order book front, same, like we're seeing, it looks like the order book volumes are down since March. Is that structural, cyclical? Again, a lot in there, but go for it.
Yeah, I'll start. So I don't think, I agree. I think they are very segmented out still. I think we would have liked to see them merge a little bit more in recent years. And I think that is turning a corner as buy side is getting more access to these D2D venues and the D2D protocols. But, you know, central limit order books have for the most part been the D2D model. And then RFQs and streams and voice have been the D2C model. I think there's definitely demand and readiness to merge those. And I think that as buy side gets more sophisticated in their execution and they want to do more electronically and they want to be able to aggregate more flow, I think it's just a matter of time. I think venues, you know, as they merge and they acquire each other and they can innovate and bring these, you know, like TradeWeb and Market Access and a few others where they have both models operating, they have the best chance of bringing them together and really, you know, providing a solution to the market that will work well for all the participants.
Yeah, and I think on the RFQ side, you mentioned something good there. I mean, if you have an RFQ that is looking at the streams before it's going out to dealers, then you know you've got that kind of integration there already. And you know, from a client perspective, they don't have to worry about these two different interfaces, and that kind of makes sense. In terms of the D2D and D2C side of things, yeah, the main difference there is on the D2C side, you're able to set up a stream that you can really tailor to a particular client, and we can show them, you know, very specific liquidity that we think makes sense for their type of flow. That's harder to do on the D2D side. I think there are some, you know, efforts going on in the market to try and bring those two things together. But typically on the D2D side, you're having to quote to the kind of lowest common denominator, and yeah, that makes it a bit harder for us to really differentiate our price streaming for clients. So yeah, I think that's one of the challenges. That we typically see the D2D venues as more of a hedging venue for dealers, and then you know the streaming and the RFQ side of things as you know, somewhere where we'll interact more directly with clients. Yeah, I think it's difficult to find real estate on clients' trading screens as well. You know, having another interface to interact with there, you know, makes it harder to build up that critical mass of activity. But yeah, I think if we can integrate these things well, as Nicola mentioned, then yeah, I think we can see some growth there.
Yeah, no, that's great. So we got an interesting audience question. I think it's picking up on something Nicola said. The question is, if innovation is being stifled because of COVID and working from home, do we need to evolve how we innovate, or do we just wait for COVID to end?
No, I think you have to evolve how you innovate, absolutely, because I don't know about you, but I'm not seeing an immediate end to the COVID crisis, and who knows after we are through this, what else there will be out there. But absolutely, we need to evolve the way we innovate. We've had to evolve the way we interact with our customers. We've all had to do that. And yeah, we have to look for more creative ways to innovate. But I think the point that I was making is that in March and April, it was just a shock. I think it was a shock for all of us. And I think many of us anticipated it would be all over by the summer and we'd be back to normal. But clearly that's not happening. And clearly this, I hate to use an overused term, but this is the new normal. And we are now, I would say, our productivity and our effectiveness in terms of how we innovate and how we deliver product is back up and running to pre-COVID levels, and that, you know, you can't wait around for things to be over. You just have to get on with it. So that's our experience.
That's great. Hey, and we've all learned how to use our webcams now without them failing.
Not all of us, trust me.
So one other good question, and then I'll get back to what we had planned. But I thought this was an interesting one. Jamie, you talked about how with streaming, you sort of, your client, you can stream those levels, right? Different than an order book. But is there any concern about, your streaming prices to a customer who then can maybe use that as pre-trade information to trade elsewhere, as opposed to an RFQ where it's a sort of a more captive audience? And I'll put that out really to everybody, Mike and Jamie, Troy.
Yeah, I don't think we are so concerned about providing that price transparency. We'll typically see that come through in the trading activity. I mean, I think from the dealer side, and this has always been an issue, no matter what the protocol, it's the thing that's most difficult from our perspective is if you have clients that are going out and hitting multiple streams, or raising an RFQ against multiple dealers, etc., and hitting multiple liquidity venues at the same time. That's always a bit harder to deal with, but yeah, I don't think we have any real concerns about showing our prices out and that being used as information by clients.
I think the pre-trade transparency thing is interesting. Now, granted, the Treasury market relative to other fixed markets trades pretty tight, particularly the on-the-run issues. But this is a market. So if you take the Treasury futures market, we have one all-to-all market with a central limit order book and kind of almost perfect pre-trade transparency. That's a single venue. You're inevitably going to get fragmentation in the cash market. But from an asset manager's perspective, there is a central limited order book out there that exists that certain market participants can see. Asset managers generally can't. And so there is pre-trade transparency available. We just don't get it. Now, yes, you can argue that our streams give some sort of pre-trade transparency, but that's not a level playing field because all those streams can be adjusted, and maybe mine are better than other people's, but maybe they're worse. I don't know. But if we have one central point, which is that central limit order book, I think that provides enough pre-trade transparency that I don't think people are going to be too focused on whether streams are providing that or not, at least from an asset manager's perspective. Again, I don't see how this market can't eventually evolve into a place where it's just one all-to-all market. And even when it does, frankly, I still think clients won't trade very differently, but it'll be more transparent and kind of a more efficient and fair market.
Mm-hmm. And I would agree with that, and not just pre-trade, but post-trade as well. I think we're advocating for stronger post-trade transparency in the U.S. Treasury market. And the more information that's out there that end users have, the better position they're going to have in managing their risk. So I would agree with Mike. Central limit order books right now offer both pre and post trade transparency when we have access to those markets, but in some of the off the runs and some of the more dated securities, you kind of struggle to get that transparency today that I think the market needs.
To that point, actually, Troy, sort of since you brought it up, if we think about some of the regulatory proposals, interesting that that trace reporting for Treasury started the first week of March, which was an interesting coincidence of data to see if the system worked. So do you think that's been helpful? Do you think that'll expand? And then there was obviously also the proposal about more registration of ATSs that are trading government securities. Sort of have any views on there you could share?
Yeah, I mean, definitely it's a step in the right direction. I think we believe that there's still a lot of room to grow with, the access that clients and participants have to trace data. We think it should be available to everyone. We think it should be done in a very timely manner, almost real time to a certain extent. Again, the more transparency there is in pre and post trade of these securities, the better position end users and clients can have to the marketplace. With Reg ATS, we're supportive of a broader overview of how ATSs are regulated for U.S. Treasuries. We think it's, especially with some of the acquisitions that have occurred over the last few years in the space, you have a lot of these exchange operators buying ATSs now and operating not just cash markets, but equities or derivative markets as well. So it's time for there to be a holistic revisiting of all of those regulations today.
Yeah. So to pick up on your point about the activity, the M&A activity in the space, I'd be curious everybody's thoughts, and there has been a lot, right? So if we think through all of the all of what's gone on over the last, say, 5 years. Obviously, Nicholas here, market access, liquidity edge, from startup to that combination, CME BrokerTech, NASDAQ's been out there with some joint ventures with Truman, TradeWeb obviously has gone public, BGC launched Fenix, right? There's a lot of sort of good innovation in the space. I mean, as some of those platforms sort of come together, what is that like as an end user? I don't know, maybe Mike, we can start with you on that because you're the end consumer of a lot of that, right? Do you think that's good or bad or indifferent? What's been the experience so far?
I mean, it's great to see innovation. What I get concerned about, and certainly I've seen in other asset classes, is when you have lots of fragmentation of providers who all are essentially offering the same thing. Vendors don't provide, or platforms don't provide liquidity. Kind of LPs provide the liquidity. And if you divide it up among 10 platforms or 5, it's still the same liquidity pool. And so I get concerned when I start to see this proliferation of venues to the point where it's actually counterproductive. And so certainly consolidation is something that I'm interested in seeing, and seeing people win on best protocols, not on other kind of more operational issues.
Yeah, that's a fair point. I don't know, Troy, Jamie, from LP perspective, what's that been like?
Yeah, I would. We don't want more fragmentation. We want synergies. I think synergies that these acquisitions are bringing to the market have shown promise. With the merging of credit and rates, which has been long overdue. We've seen a lot of not just M&A but more VC or JV kind of strategic partnerships happening in the space because the two markets are converging into each other, even more so now with where interest rate markets are today. So I think with the acquisitions that are going on, we're encouraged by what synergies and efficiencies can be brought to the market by bringing a broader scope of product base, using similar protocols, using universal platforms, easier for liquidity providers to provide liquidity in multiple fashions. Are all positives, I think, in the long run.
Yeah,
I mean, from our perspective, competition is definitely a good thing. However, back to Michael's point, there is a limited size of opportunity in the UST space, and too much fragmentation means there's not going to be enough volume to go around. I think it also makes it more complex for clients if you have a ton of different venues where you have to go and look for the best price. So there is probably a right number in terms of the number of venues that will ultimately be there.
Yeah, I was just going to say where the M&A makes sense, it's a good thing. Obviously, one of the key drivers of market access's acquisition was driving efficiencies with corporate hedging, and of course creating the logical complementary products between rates and credit. There is a sweet spot, absolutely, with the number of venues, but again, competition is healthy for the market. It keeps us all competitive, keeps us all on our toes, and it's those that get it right with the innovation and the product and the protocols that will survive.
I think what a lot of this is showing is maturity in this space, right? That we've been through a big cycle of change. I know we're talking about treasuries, but obviously in corporate bonds as well, and the consolidation is a natural evolution there. And I think Troy pointed out about some of the platforms being acquired by the exchanges, but really even some of the platforms are now effectively big exchange groups in and of themselves, especially if you look at the size of some of them. So so it's a good sign of progress. So to sort of flip it on its head, let's talk a little bit about the market participant changes. I think we saw some interesting things, that sort of played out in March. While e-trading hit record absolute volumes in March, we also saw a big uptick in the use of the phone, right? So dealer balance sheets really mattered. And then obviously non-bank liquidity providers are a big part of this market. So let's talk a little bit about that. Maybe Jamie, maybe we'll start with you on that one. If you maybe some of those dynamics were back in March and how that played out with the voice and the E and the balance sheet usage and how you interacted with customers and what that's turned into.
Yeah, sure. It's definitely a very interesting period. I mean, we didn't find that our kind of electronic automated activity was really constrained by balance sheet. We were still able to get out of risk and manage that fairly well. Obviously, as we move into the off-the-run space, and this is kind of more for the voice desk at this point, that was an area where there was more focus. However, if you look at the period March and April, we were seeing a lot of position unwinds. Particularly from RV funds, but we were able to increase our balance sheet by around about 25% and absorb a lot of that coming into the market. So, it worked reasonably well from our perspective, but I think as you move out into the off-the-run space, that does become something that you need to think about a lot more carefully.
I don't know, Troy, you want to pick that one up? I mean, I think I would hope at least the view of non-bank liquidity in general, but specifically in treasuries has changed, right? This isn't just about anonymous market making now, but obviously sort of name disclosed trading with customers as well. Yeah.
Yeah, and I think the interesting point that I think has been made, with March and going into April was the elevated activity of those off-the-run securities that we're trading. You don't have the wide array of liquidity providers that will make in off-the-run securities. You have plenty in the front of the curve or the front of the durations, with market making, but as you are moving some of those backdated securities, you need more market makers. So by providing easier access to electronic protocols and the ability for firms like Citadel Securities to make liquidity in those securities, which we do today in other venues, will improve that capability to execute electronically versus go to voice, because that's just the natural flight to quality for a lot of buy-side participants when they're trying to move things, or even international participants, right? It's probably more of the international participants that were probably gravitating to the voice trading to get those securities moved that they were trying to balance, in March and April. But we would also say that this is probably a good time to potentially revisit central clearing for U.S. Treasury as a way to remove some of that bilateral risk, or make it easier for market makers to come in and provide liquidity in all of the securities.
Yeah, it seems the SEC is thinking the same. I don't know, Mike, Nicola, anything else to add there?
I think just about just on off the runs. Obviously, when we started out, we were exclusively on the run liquidity in a streaming capacity, but we always had plans to launch off the runs, and we did back in 2016. But it's been a slow burn on the streaming side, and that's largely due to the fact that just not enough liquidity providers out there being able to stream them. But absolutely, that has changed in this year, actually so much so that the number of liquidity providers streaming liquidity on market access rates in off the runs has doubled. So we're seeing a much greater uptick, and I'm sure that's a result of the environment that we're operating in. On central clearing, I'd be interested. Obviously, there was a recent paper written about the benefits of central clearing in relation to dealer balance sheet constraints. I'd be interested in Jamie's opinion on that. But I mean, ultimately, the economics have to be right for all the participants in order to back a central clearing option. That's fundamentally, I think, one of the biggest challenges to wholesale change there.
Yeah, I mean, making it more difficult for dealers to hold balance sheet is probably not going to improve the situation during periods like March and April. So yeah, that would be our general view there. I think if the regulators want dealers to be able to step in during these times of stress, then we need to be able to have some flexibility around expanding that balance sheet, and that's exactly what we saw in March and April.
Yeah.
Michael, back to the off the runs. I'd be curious. Do you have streaming off the run prices? Is the liquidity in that regard changed this year?
Look, I mean, streaming off the run prices is a challenge. It's it's something I think, off the runs and tips are something I suspect every liquidity provider and venue, when they talk about treasuries, that's the first thing the buy side asks for. It's something that I think everyone on the buy side universally wants and there's demand for, but we recognize the complexities of providing that are why we're not seeing this. I mean, typically when people on like asset managers like us are all united in demanding something, usually it happens. In this case, it's a unique scenario where I think generally this is what we all want, but getting it reliably has been a real challenge.
Yeah, for sure. Great. So we're gonna step into some of the questions here as we're getting a little short on time. So this is an interesting one that came in sort of towards the beginning of the conversation, thinking about how how the liquidity providers and the venues would look to increase demand effectively, right? So is it about improving the quantity of the liquidity, about building new tech, offering new products? I mean, what seems to be what are the top things from a growth perspective for you all in that regard?
From my perspective, the top thing is workflow integration. We need to make it as easy as possible for clients to access the best liquidity pools, whether they're delivered via streams or via RFQ or any other protocol. It's not an either or for us. It's going to be a protocol choice depending on the liquidity profile of the instrument and analytics and workflows to back that up as to where you would best execute.
Yeah, I mean, I would echo Nicola's point in terms of workflow integration. The other things that we're working very actively on is product coverage. So we really want to have a price for the entire rates universe, not just kind of on the runs and the first 3 olds. We want to be able to cover the entire off the run curve, EGBs, whatever it is, the entire rates securities universe, including EM. And then we're also looking at integrating a lot of the algo trading capabilities that we have within our FX franchise into rates as well. So I think that's another interesting area, and how that will interact with things like streams. I think is going to be something that we'll start to see some traction on in 2021, hopefully.
Yeah, similarly for Citadel Securities, we're constantly looking at expanding our product base so that our clients have more to trade with us when they come to trade with us, and they don't have to come to Citadel Securities for one market and potentially go to someone else for another market. So that's an effort that we've continued to expand on over the last few years, and as we add more products into our market making portfolio.
And for you, for Citadel Securities in particular, is that a technology data problem, or is that a risk taking problem?
It's a time bandwidth problem. It's just fine, getting the right talent in that knows those markets, then building up the models, building up the capabilities. So it's just a natural progression as we continue to build out our business of those products. I think when you have a venue and a platform that makes it easier to access all of those markets, it gets us to market quicker. But when you have certain venues that specialize in certain securities, then that's where you start to see barriers to entry, because then it takes more time to develop to those APIs, or they might have a proprietary protocol, or one's a stream versus an RFQ. And so that's, I think, kind of just bringing everything together of what we're talked about today is, ease to access the market. The more product base you have on a universal platform is what's really going to help grow, grow the pie overall.
Sure. All right, and then we'll do one last question and we'll wrap it up. So this is a question about clearing. It says, do we think the buy-side community will fully participate, or do they prefer the access that they have now through an intermediary? And I guess, Mike, you are the token buy-side on this panel. So what are your thoughts on clearing and treasuries?
Look, I think the buy-side will ultimately want to have clearing and treasuries. I think it'll make it cleaner, facing a wider range of counterparties, kind of in search of best execution, and also may open up down the line the ability to trade on platforms as this market potentially becomes a more all-to-all market. I think one of the biggest barriers to clearing for the buy side is for them to really, or for the buy side to really understand what that means. I think when you go to most, say, asset managers and talk about clearing, they're thinking about futures and OTC derivatives, and they're not thinking about cash products. So I think there's some education that has to happen first, and once that happens, I think the buy side will want to participate in that. I mean, the Treasury market, you know, the LPs in the Treasury market look a lot different than they did 10 or 15 years ago. It's no longer just, you know, the banks that asset managers are most familiar with, the biggest banks in the world, or certainly in the US. There are other market participants as well, and I think clearing makes that smoother to interact with all of them. But again, I mean, I'm not sure that that's well understood in general on the buy side.
Yeah, I think that's right. Any other thoughts on clearing?
Yeah, I would just add that, you know, I think, you know, one thing that doesn't get talked about a lot in these forums is just, you know, access to repo and transparency of the repo markets, where clearing actually could probably add the most benefit to US Treasuries.
Great, thank you. Good, so I think we're just about out of time. There were a couple of questions about protocol usage and percentage and change over time. We do track that, forgive the shameless plug, we do track that monthly in our Market View app, so if you're a client, check it out. If you're not, shoot us an email, happy to talk about that in more detail. But thanks to this great panel. I'm sure you're all busy. It's crazy year, crazy market, but thanks for your insights, really helpful. And let's get back together after the election at some point and see how it all turned out. But thanks so much for your time, and thanks everybody for listening.
Thank you, Kevin.
Thanks, Kevin.
All right, take care.